smart tax tips for the new year. My name is Beth Lynch. I'm one of the advisors here at Fort Pitt. I want to welcome back a lot of the individuals that have watched many of our webinars, and also welcome all the new individuals that have signed up to listen in. We do have all of our webinars on our website, so the past ones, please feel free to go look at those. A lot of you do know a lot about Fort Pitt Capital Group and what we do, but for our newcomers, give you a little background about Fort Pitt Capital Group. We have been around since 1995. We are a registered investment advisory firm. We do all of our investment management in-house. All of the decisions on securities that are put into our portfolios are done by our asset management team here. We have a lot of advisors, and all of our clients work with a dedicated client advisory team. And we take a very personal approach to our financial planning, wealth management. Each of our clients receives a plan and dedicated and customized investment strategies to help them meet their goals. We also have business consultation and 401k planning. We really pride ourselves in our exceptional client service and take a holistic approach to our financial planning. And we'd like to be as transparent as possible. Again, I was talking a little bit about our webinars. We love giving our webinars. These are always free to our clients and to our community. We're looking to empower each and everybody out there on different topics. So we want to tackle the life questions that affect you financially and hopefully guide you to meet your goals and get on the right path to success. Again, my name is Beth Lynch. I'm one of the financial advisors here. I'm a CFP. I have been with Fort Pitt Capital for 6 years and in the industry for over almost 30 years now, and a CFP for 20. I enjoy what I do. I absolutely love helping individuals and families work on their goals, help them set their goals, and achieve those goals. We encourage you to interact. We encourage you to ask questions. And so you can see that if you are on a device, there should be a little question mark in the bottom right-hand corner where you can ask questions. And if you're on a computer, you can find the question tab in the middle of your screen, again, to the right. Okay, we have lots to cover in the next 50 minutes or so. So I put out an agenda here. We're hoping to touch a little bit on each of these topics. So we're going to talk about maximizing your retirement plan, contributing to a health savings account, funding 529 plans, investing in individual stocks versus mutual funds, buying municipal bonds, doing charitable giving, and Roth conversions. So this year, there really aren't any earth-shattering new tax laws for 2024 yet. Most of the changes are inflation adjustments and new limits. The federal tax brackets are staying. The 7 tax brackets are going to remain unchanged at the 10%, 12%, 22%, 24%, 32, 35, and 37. However, the income thresholds in those tax brackets are moving up. So for example, if you have a married filing jointly, the 24% tax bracket for 2023 was about 190,000 to approximately 364,000. For 2024, that threshold is going to move up to 201,000 to approximately 384,000. So they've moved that up about almost $10,000 on the low side. The standard deduction is also going to increase by $750 for single filers, and married filing jointly will increase by $1,500. The gift tax exclusion for 2024 will be $18,000 per person, so that's up $1,000 from 2023. And those with estates below 13.6 million will not be subject to estate taxes. Also, HSAs, which we'll talk about shortly, their contribution limits for 2024 are rising also to $4,150 per individual and $8,350 for families. Again, no major changes so far this year for 2024, but I feel like Congress loves to pass bills and laws at the end of the year, which is what they did with Secure Act and Secure 0.20, which all passed at the end of December and had all of us scrambling to figure out what we needed to do. So I say that there are no major changes yet. We'll see if something gets passed. With that said, let's talk about how you can save more money for retirement and pay less in taxes. Who doesn't want to do that, right? So why should you maximize your retirement plan? Saving into your employer plan is like dollar cost averaging. So in 2023, the maximum that you could put in to a 401k, 403b, or 457 plan was $22,500. And if you're age 50 and older, such as myself, you get that added catch-up contribution of $7,500. In 2024, they're going to raise that just slightly to $23,000 and keeping the catch-up contribution at $7,500. By doing a max contribution to your 401k, this is going to reduce your taxable income, so less taxes that you will pay to the IRS. Along with that, you're also helping yourself save more dollars for retirement. So when we have money that is going in each and every week or bi-monthly, your dollar cost averaging, I mentioned that earlier. So you're able to go in and buy more shares when the market is down and maybe less shares when the market is up. Plus, you'll have a company match most of the time. This will help compound your returns and increase your retirement account just by that compounding, the magic of compounding and growing your assets. The more you put in, the more that'll go up. The earlier you start, the more money you'll have at retirement. So if you're able to put the money in there and max it out, you will definitely see the benefits. Secure 2.0 had originally noted that anyone that was making $145,000 in 2023, the catch-up contributions would have to be saved into a Roth for 2024. They were unable to get all of the plans to have Roth IRA or Roth 401ks in them. So that has now been extended to begin in 2026. So that is one change that was made earlier this year, I believe in June. The plan participants and the programs the employers could not get those Roth IRAs into the 401ks quick enough to be done by the end of this year. So the IRS gave them an extension. And Roths are pretty good, right? So Roths are not bad. This is a way for high income earners to put money into a Roth that they may not have been able to contribute outside of their employer due to their income limits. So for example, in 2024, if you're single and you have a Roth IRA contribution that you want to do, you're phased out at $146,000 and completely eliminated if you make more than $161,000. So you may not be able to contribute to a Roth. And Roths are wonderful because they grow completely tax-free. And when you withdraw them, all of those dollars that you withdraw are tax-free. So you're making contributions with taxable dollars. So it's not going to reduce your taxable income, but this gives you more buckets to withdraw from in retirement. And I talk about buckets quite a bit, and having different buckets in retirement, the advantages of that, being able to take out from taxable accounts that you're only paying capital gains versus tax deferred, such as IRAs and 401ks, where when you take those out, all of the money that's coming out of there is considered ordinary income. And then the Roth, which comes out completely tax-free. This can help you navigate through retirement and control your taxes when you have different buckets. So being able to have a Roth inside the 401k for high earners is a huge advantage for you to be able to start saving tax-free money. So when you're looking at your taxable income and other income, it could make sense for you to do a portion of your 401k contributions to traditional and some of it to Roth. So if you're able to direct some of the Roth to the Roth without putting yourself into the next tax bracket, that would be very wise. Health savings accounts. I love health savings accounts, and a lot of people don't really know the benefits of a health savings account. Being able to put money into your health savings accounts also reduces your taxable income, and it grows completely tax-free. So two benefits, right? So it's almost like an IRA, a traditional IRA, where you get the ability to reduce your income, but it has Roth components where you're growing completely tax-free and the money comes out completely tax-free when used for healthcare or medical costs. And you can invest these dollars. I always tell my clients that they want to keep in the cash portion at least their deductible in case some large emergency medical event happens that they do want to use their health savings account. But I also advise them that if they're able to keep that health savings account to grow and not use it and pay for co-pays and medications out of pocket and continue to let that health savings account grow, you can use those dollars in the future. You don't have to use these dollars within the year that you're putting them in, which is what a flex spending account a lot of people have. So you either have you may have a flex spending account or an HSA. If you have the HSA and you grow that, you can accumulate all of those dollars and use them later for long-term care premiums, for vision care. And we all know once you hit Medicare, hearing aids are not covered by Medicare, so you can use it towards hearing aids. You can use it towards home modifications for medical purposes, you know, ramps, grab bars, things like that. And you can accumulate expenses. So if you continue to keep all of the receipts for your co-pays and the medical, for prescriptions, at some point, you can go back to the beginning of when you had an HSA, total all of those expenses up, and take a lump sum withdrawal for that amount if you have that much in your health savings account. It's a great accumulation account. Also, the health savings account does transfer upon death to your spouse. So you can name a beneficiary, and that spouse can then continue to use what is in there for their medical expenses. And if there's still some at second death and you have children, a non-spouse has 12 months to make tax-free withdrawals for any unused expenses. And that could be the Medicare premiums for, you know, Medicare Parts A, B, C, and D, not supplemental plans, not health advantage plans, but for those Medicare A, B, C, and D. So if you keep track of that, again, you can total those up and make a lump sum withdrawal from your health savings account. A lot of individuals aren't aware of the benefits of their health savings account and how much money can save you later. 529 plans have also been a pretty big topic. They made a few changes for grandparents versus parents owned. And also a lot of states allow you to deduct contributions to a 529 plan for a child, a niece, a nephew, a grandchild, which can help on your state taxes. So you're not going to save on federal taxes here, but you will save on state taxes. You can also front load your contributions, which I will touch on in a moment. And the grandparents versus ownership versus parents. There used to be a kind of a pitfall if the grandparent owned the 529 plan, and now it is a very similar advantage for parents or grandparents to own the 529 plans. Front loading. So let's go back to front loading. You can do up to $18,000 per year forward looking for 2024. 2023 was $17,000. So you could put $90,000 into a 529 plan. And by doing that, it's basically a 5-year gift. So you can put it in, let it continue to grow. It's the, again, power of compounding and increasing your college fund for your children or grandchildren. The grandparents versus the parent-owned 529 plans are a popular way for grandparents to save for college, and for good reason. With a 529 plan, you can build an education legacy for your grandchild and take advantage of the tax and estate planning benefits. Like I said, the FAFSA has changed, and for the 2024-2025 years and forward, this is a great time for grandparents to start setting up the 529 plans. At this point, they will not be affected. So kids that had 529 plans, the beneficiaries, when it was in a grandparent owned, any income that came out, even though it wasn't taxable, it went against the child's ability to get financial aid. And that loophole has been closed. So for example, if it was a parent-owned asset, it only reduced the aid by a minimum or maximum, sorry, of 5.64%, where when it was a grandparent-owned, it could affect it by as much as 50% of the cash support. So that loophole has been, it's kind of closed now, or I should say it's open, that now grandparents can give, and it's not going to affect the benefits that the beneficiary will receive. So 529 plans, they grow tax-free. You get tax-free withdrawals for qualified expenses. I mentioned before that you can get a state income tax deduction. 30 states allow this right now. The state does determine how much that tax deduction is. Pennsylvania is one of, I believe, 5 states that allows a deduction from the state, from your Pennsylvania state tax, no matter what state plan you use. So if you have a grandchild that has a 529 plan in Virginia or Nebraska, you can contribute to that plan and still take a deduction on your PA taxes. For Pennsylvania taxpayers, for 2023, the deduction is up to $17,000 in contributions per beneficiary per year, as long as they had Pennsylvania taxable income of that same amount. So that's a huge benefit. The other is the federal gift tax. You can contribute up to, it was $85,000 for 2023 or $90,000. Like I said, it's going up to $18,000 per year for each beneficiary without incurring federal gift tax. This amount is prorated over 5 years. I have an example in there that if you contribute $30,000, it would be considered $6,000 per year for 5 years. Like I said, we will have an increase to $18,000 for 2024. Also for federal estate taxes, if you die with money remaining in that account, it will not be included in your federal estate tax for federal estate tax purposes. If you do the average gifting, the bundling and lump sum at the very beginning that I just mentioned, and you die within that 5 years, it is prorated back, and that portion becomes subject to estate tax. Pennsylvania inheritance tax also, the funds in the account are completely exempt from PA inheritance tax. And so if you think about that, if you're an aunt, an uncle, or a grandparent, that could be a savings of 12 or 15% from Pennsylvania inheritance tax being left to the beneficiary. So that's another tax savings. And I figured I'd just list some of the qualified expenses for 529 plans. Not really a tax saving tip, but just so that you know kind of what those 529 plans can pay for. And now that they've added for elementary and secondary school tuition, there's a limit. I believe it's about $10,000, and that will inflate for inflation also. Okay, so investing in taxable accounts, individual stocks, versus mutual funds. When you're investing in taxable accounts, it's important to understand the tax ramifications of the types of securities that are in your account. Some are more tax efficient than others. So for example, if you have individual stocks, you may not owe any taxes on those securities, assuming you don't sell them in that year and they don't pay any dividends, which a lot of growth stocks, your tech stocks, do not pay dividends. And so it's very possible that you have very minimal taxes owed in a year when you use individual stocks. However, if you do sell them, you would pay a capital gains tax on the difference between what you paid for it and what you sold it for. The capital gain, these are at lower rates than ordinary income rates. So currently the long-term capital gains rates based on your income are either 0%, 15%, or a maximum of 20%. So you have some control over what you sell, how much you sell, and can limit your gains in your tax that would be due on those capital gains. Anything held for longer than a year would be a long-term capital gain. Anything less than a year is going to be a short-term capital gain, and those are taxed at ordinary income rates. So if you are planning on selling a stock, you want to make sure that you're paying attention as to the purchase date and the sale date, and make sure that it's a year or longer to take advantage of your long-term capital gains rates. You can also offset gains and losses from other securities. So again, taking control of your taxable gains. Let's say you have one security that you sell and you have a taxable gain of $10,000, and you sell another stock for a loss of $5,000. You would only owe taxes on the $5,000 net capital gains. And we do quite a bit of this tax loss harvesting for our clients in their taxable accounts. We can put tax capital gain budgets so the client has an idea of how much that they're going to owe in taxes based on the realized gains that we take within their accounts. Mutual funds, on the other hand, you don't have any control. They do capital gains distributions at year end most of the time. So this means if they've made trades in those funds throughout the year, they are required to distribute those capital gains to their shareholders in the form of a capital gain distribution. And like I said, this usually happens in November and December, and you have no control over how much is going to be distributed because it's part of a pooled fund. And you can't really offset the gains and losses in there. So you could have a surprise tax bill even in a down market. We've had many years where clients have seen mutual funds or even their portfolios go down. But when you have a mutual fund that pays a large capital gain throughout the year, you could still owe taxes even though that fund has gone down. Understanding how your investments are taxed is very important. There's also a few things that you can do and strategies that you can use to save on taxes. And I did mention the tax loss harvesting. You can take losses to offset realized gains. You can do that with mutual funds also. If you're selling the full mutual fund or even portions, you can have carryover losses into the future. So I had given you the example of the selling at 10,000 of gains and 5,000 in losses. Let's flip that and say that you sold a stock for a loss of 10,000 and another stock for 5,000 gain. That means you have a loss, a carryover loss of $5,000 that you can use in future years. But you are able to use of that 5,000, 3,000 each year as a deduction above your offset. So you can have a deduction of 3,000, in which, in this example, then you would have a carryover loss of 2,000 that you can use next year to offset any capital gains. The other thing you can do from non-retirement accounts is you can send cash from them. If there's money in there, you can use that as a tax deduction. You can give money from your savings or checking. And if you itemize, you would be able to itemize that charitable gift and reduce your taxes. And the other thing that we do a lot of is appreciated stock. We can give appreciated stock to a charity, in which case you avoid the capital gains on the appreciation of that stock. The charity receives the gifts and you receive a tax deduction. Again, you want to look to make sure that you are able to itemize, because the standard deductions are a lot higher than they ever used to be, and they continue to move up. So you need to have enough in itemized deductions to take advantage. But this is a great way to avoid capital gains if you're already charitably inclined, is by using the appreciated stock. Bonds have been a hot topic lately with the Fed raising rates. We finally are seeing higher coupons on bonds. We're enjoying some higher interest that we're receiving at banks. But municipal bonds, or munis, can be a great way to invest in fixed income and enjoy tax-free income. But muni bonds are not for everyone. You should discuss whether or not they are fit for you with your financial advisor and your CPA. Generally, they are federally tax-free interest that you earn. If they are issued in your state, they can be state income tax-free also. And a lot of individuals will say, well, Beth, the municipal bonds have a lower yield to them, or a coupon. And why wouldn't I just buy a corporate bond? So what we can do is figure out what is that tax equivalent yield for buying the municipal bond. So I threw an example up here. So if you have a municipal bond that has a 4% coupon, 4% interest, and you're in the 35% tax bracket, you take that 4% and divide it by 0.65, 1 minus 0.35, your tax rate. That gives you a tax equivalent bond of 6.15%. So that's a huge savings, and it's a great investment for those that are in the 35% income tax bracket and live within the state with relatively high income tax rates. So you can get the federal deduction there, or the federal tax-free interest and state income tax-free. The coupons on the corporate bonds can look really good. In fact, some of them are even higher than what you can get in muni bonds. So you definitely want to talk with your advisor and your CPA to see whether or not this is something you would want to do. If you're in a lower income tax bracket, such as the 12% tax bracket, you probably want to stay clear of the municipal bonds. You're not going to get as much of a tax advantage as someone who is in a higher tax bracket. This is a great way to add fixed income to your portfolios if you're going to need some additional cash in retirement. Next, we have the charitable giving and setting up donor advised funds. Obviously, there's many ways to give, and I just mentioned a few of them. You can give cash directly to the charities and get a deduction. You can use appreciated stock, but a lot of individuals aren't familiar with donor advised funds. A donor advised fund, you can open and contribute to them annually, semi-annually, every other year, whatever you would like. What's so appealing about donor advised funds is that it allows for a tax deductible gift in the year that you put the money in there or the securities in there. And it also allows the ability for you to dole out those funds to charities over multiple years. So a lot of times we talk about bundling gifts to charities. So this is where you could make a large gift in 1 year to the donor advised fund of, let's say, $30,000. And then you could get the deduction of $30,000. And if that's over the standard deduction, you would itemize. And then you can dole out those charitable gifts over 1, 2, 3, 5 years, however long you want. But you get the deduction in the year in which you put the money in there. So it's a great way to overfund your donor advised fund for future charitable gifts in 1 year, and then perhaps take the standard deduction the following year. And if you do that every other year or every third year, it's a great way to take advantage of tax deductions. Okay. Next is charitable, qualified charitable contributions. So QCDs, which they're very well known for. You hear us talk about qualified charitable distributions all the time. And this is a direct transfer of funds from your IRA to a charity. The nice thing about qualified charitable distributions is that it does count towards your required minimum distribution. And so no taxes are paid on that. This is above the line. This makes more sense than gifting to a charity cash and writing a check and having to take your required minimum distribution. You can do it directly to the charity, and they get the benefit. But you want to make sure that when you're doing these qualified charitable distributions, that the charity that you're sending it to can accept them. Make sure that they can accept either cash or securities that you are giving away for your qualified charitable distribution. The other thing is you must be 70 and a half and older. So not everyone can do this. This sounds like a great way to reduce your RMDs for future years, but you do have to wait till you're 70 and a half and older. And even though they increased the required minimum distribution age to 73 and for 75 for anyone born 1960 and later, you are still able to do the 70 and a half, these qualified charitable distributions. And the nice thing about them is that could reduce what you will have to take out in future years. And starting in 2024, the $100,000 limit that you can do will be indexed for inflation. So the qualified charitable distribution limit for 2024 is increasing to $105,000. So this is a great way if you are charitably inclined to give, and you will not be taxed. This can keep your taxes low. This helps with Medicare. The IRMA that you would have if you have large required minimum distributions, this is a way to reduce that down and also bring down Social Security tax that happens when you have qualified income. And I didn't mention this earlier with the municipal bonds, but you also have to keep in mind that municipal bond income, even though it is tax-free, it does get pulled back in for IRMA and for Social Security purposes as part of the modified adjusted gross income calculation. So it doesn't avoid everything, but it does help from a tax standpoint. So we love QCDs. We do quite a few of them. You do want to make sure that you do them early and that the charity cashes those checks before December 31st to make sure that it does come out of your IRA on time and count for the current year. These are becoming very popular, and so there are a lot of times your custodian has cutoff dates. It's really important to make sure that you work with your advisor to get these done as soon as possible so that the checks can be out and that the charities cash them in a reasonable time to qualify for the current year. Roth conversions. So love Roth conversions. Some people love them, some people hate them. They're not for everyone. We get a lot of questions about Roth conversions. CPAs, there's some CPAs that really push to do some Roth conversions, and there are others that do not like them, believe that there's too much tax on them. You do need to be very careful as to when you do a Roth conversion because of the tax ramifications. So a lot of times we get the question, when is a good time to do a tax or do a Roth conversion? It's, anytime money is converted from a traditional to a Roth, it's treated as ordinary income. So based on your tax bracket, it's going to determine how much you're going to owe in taxes. So it does make sense to do a conversion during a year when maybe your income is unusually low. Maybe there's not a large bonus. maybe you're partially retired, you changed jobs. There's multiple reasons that you could have lower income. It's even possible that you didn't have as many gains in one year, and so that might be a good year in which to do a Roth conversion. Another good time to convert from a traditional to a Roth is when the market is down. Your traditional IRA has lost some value, and or your income is lower. And people say, Beth, why when the market is down? Why would I want to take money out of my traditional IRA when the market's down and put it into the Roth? Yes, you'll pay tax on the amount that you take out, but transferring it from the IRA to the Roth, number one, this allows you to avoid future higher required minimum distributions out of the IRA, and it puts it into a strategy or an account, the Roth, that will go completely tax-free, and any withdrawals from there are tax-free. So getting it in there low while the market is down, you're going back into another account and buying low and having time for that to appreciate. Roths are something that we look to very rarely invade unless we need to for tax purposes, but Roths are a great asset, a great account to leave to our heirs because it is completely tax-free. The other question we get a lot is, can I do a Roth conversion after age 73, after my required minimum distribution? And the answer is yes, but you need to be very careful. So when you hit the date in which, or the year in which you have required minimum distributions, 73 currently, moving up to age 75, you need to make sure that you take your required minimum distribution prior to doing any Roth conversions. So this could increase your taxes for that year. So again, you want to make sure that you're in a lower tax rate. Maybe you can do the qualified charitable distributions to reduce how much has to come out of your IRA for RMDs. And that would be a great time to then do the same amount that you would do for your required minimum that you're sending to a charity as a Roth conversion. So making sure that you're doing some tax planning throughout the year, and then at year end, determine how much you have to take, what your capital gains are, and how much makes sense to do a Roth conversion so that you're aware of how it will affect Social Security, how it will affect your Medicare premiums, and looking forward. Because anything that you do today in 2023 with Roth conversions, if you're 63, it's going to affect when you turn 65 and apply for Medicare. It's a 2-year forward and income. Should I pay my taxes from my IRA or from after-tax money? This is also a very, very popular question. And we try to make sure that if we're doing a Roth conversion, that we want to, in most cases, use after-tax money. We want to get as much taxable money into this tax-free growth account and let it grow for the future. The compounding, the tax-free compounding that is going on in the Roth. So we can get more in by using after-tax dollars to pay for the taxes for the conversion. So for example, let's say you do 100,000, 20% tax bracket. Now you're only putting 80,000 into the Roth instead of 100 if you take the taxes out of your IRA and instead of taking it out of taxable money. So there is a benefit. Now, there are times when individuals can't or don't have the dollars. So we will make, we will say, that's fine. Let's use the IRA. We'll withhold some taxes and do the required minimum distribution for, and have the taxes withheld and put the rest of it into the Roth. Like I said before, doing a Roth conversion does reduce lifetime taxes, future taxes, future withdrawals that you have to do. someone asked about, this is what I was looking at, any workaround for required minimum distributions while still working and contributing to SARSEPs, but would like to do QCDs. So if you are actually still working, if you have a SARSEP and you are contributing to the SARSEP, you are not required to take out required minimum distribution to an employer plan as long as you're still working and contributing to that. Now, if you have an IRA, that's different. So you would still have to do the IRA, but you could do the QCD from the IRA. And then again, if you're still working in contributing to your employer plan, you do not have to take a required minimum distribution. So I hope that answers that question. I saw that pop up. Secure Act. I'm going to go back to this Roth conversion. Secure Act. When Secure Act came in, we got rid of the stretch, and that was where if you left money to a non-spouse, your children were able to stretch out the distributions. So what that meant is you leave your children $100,000 in an inherited IRA. It would take about 45 years was about the time of withdrawals based on the distribution rates that were calculated, and they could slowly withdraw from that inherited IRA. The Secure Act put in that there's now a 10-year distribution. So now that $100,000 needs to be distributed from those accounts over a 10-year period. There's a minimum required. You can take out more. And so working with an advisor with your children on how they would distribute that, because they could be in high earned income years where, waiting to take out a lump sum in year 10 could affect their taxes. This is where Roths really do come into play, because if the more money you can get into a Roth, even though they have to take out from an inherited Roth also over 10 years, all of those dollars are taken out completely tax-free. So if there is an inherited IRA and an inherited Roth, there's at least some dollars that are tax-free that could help pay with the taxes for the inherited IRA. Also, if you're charitably inclined and you have enough in Roth that you've already converted or that you've accumulated and you leave that to your heirs, naming a beneficiary, naming a charity as a beneficiary on your IRA is a great way to avoid some tax and this 10-year distribution rule for your children. Again, every situation is completely different, and you want to work with your advisor to see what makes the most sense for you and the goals that you're trying to achieve. Okay, I know we had a few questions. I know we covered a lot. Did it in 43 minutes, so that's pretty good. Excited about that. I'm going to go back up here and see what questions we have. We had a question about muni bonds. Is it better to invest in bonds directly instead of bond funds? Yes. So if you're able to do individual municipal bonds, again, it comes back to control of those bonds. And if you are doing municipal bonds and you hold them to maturity, you're not going to pay any tax on that gain. On the municipal bonds, you're just getting, it'll mature. And all of that income, again, is tax-free. Where in the municipal bond funds, it's very possible that because of the other funds that are in there or the other bonds that are in there, they're not state specific. You could owe some state taxes on there. So you can really direct individual municipal bonds based on your state or states that are tax advantaged for you and save state and federal taxes. Inside bond funds, you can't see what bonds are in there, so not all of it will be state deductible for you. See any other questions? I'm trying to remember some of the questions. Does PA tax net unrealized appreciation remove from 401k. It's PA time. Okay. Does it cause a mixed match between Fed and state tax forms? That is a great question for a tax attorney. I will tell you, I'm not a CPA. I will honestly say I'm not sure for PA taxes how NUA is removed. Just as a background for anyone, if you have stock, company stock inside your 401k, there's a way for you to remove that stock from your 401k and only pay federal tax on the cost basis, and then move that into a taxable account where it then allows you to use, if you hold it for more than 1 year, the capital gains rate, like long-term capital gains rate, and it gives you a basis. I am not sure for the PA, I'll be honest. I can look that up and find out. I'm assuming we can figure out who asked the question. So we'll make sure we get in touch with you, and I will ask one of my attorney friends how PA taxes anyway. I think that's it as far as questions, correct? I think we're good. Great. Well, I want to thank everyone for joining the webinar today. I hope you found it educational. I hope you got a few tips and tricks, not only for yourself, but maybe for a parent or a child or just a friend. And if you have any additional questions, please feel free to reach out to us. We're always here to help you save as much money as we can in taxes and help you grow your wealth. We do have a few upcoming webinars coming up in January and February. In January, we have all about trusts, and then in February, how to choose stocks. You can register for all of these webinars on our website, www.fortpittcapital.com. Under the resource tab, there's a webinar and events tab where you can register. And again, I want to thank everyone, and happy holidays to you all. Have a great day.